Hello, and welcome to FastPass University, the only place where you can learn all your insurance exam content free, state by state. No paywalls, no giant courses you're forced to buy, just clear lessons that help you pass fast. And today we are going over California life and health insurance laws and regulations. If you haven't done so already, please go back and watch part one, California state laws and regulations common to all lines first. That lays the foundation for what we're building on here, and I have linked that below in the description. The laws and regulations portion of your insurance exams are broken up into two parts. The first part is insurance laws and regulations common to all lines that will be on every exam, no matter what you're taking, whether it's life, health, property, casualty, personal lines, commercial lines. You need that part one. And then everyone's part two will depend on which exam they're taking, right? So if you are taking the life and health insurance exam in California, then this is your part two. This is what ties in all of the laws and regulations and will have you ready to sit for your exam in regards to laws and regulations. If you are taking another exam, property and casualty, personal lines, commercial lines, those will all be in the property and casualty laws and regulations video. So that'll be a separate part two. I have also linked that in the description. But let's jump in. So, as I said, California life and health insurance laws and regulations. These are going to be the laws and regulations that are pertinent to the life and health insurance exam and industry in the state of California. While we did go over all of this in part one, so you should be able to breeze right through this. So we are not going to spend a lot of time on this little bit of a recap, but I do want to, again, emphasize the most important parts because, repetition is an extremely important part of learning. Never hurts to kind of hear the same things, recap your knowledge. So, CDI, California Department of Insurance. They regulate all insurance activities in California, and it is headed by who? The insurance commissioner. What are some things that we need to remember about the commissioner? They are an elected official and they serve 4-year terms. They are responsible for protecting consumer interests, protecting the public. That is their main goal. And enforce insurance laws. They also have the licensing authority. So when you pass your exam, which you will, the commissioner is the one who will issue your insurance license. And when you complete your continuing education and renewals, you'll get your license renewed, all handled by the commissioner. And for anybody who does perhaps violate any insurance code laws, rules, or unfair trade practices, the commissioner is also the one who can suspend or revoke producer license. All life and health insurance producers must be licensed through the CDI before conducting business in California. So when you walk out of your testing center with a pass, that does not mean you can just go start selling life insurance policies. You need to wait until your license is issued. It's usually fairly quickly, but you do have to submit your fingerprint and background check. And then the commissioner will issue your license. And then you need to get appointed with a company, all that good stuff. A couple other enforcement powers of the commissioner. They can investigate complaints, conduct hearings, impose fines and penalties, and pursue criminal prosecution for insurance fraud. Penalties double for violations involving seniors. So we're going to get into the different fines and penalties in relation to licensing and to fraud. But from our recap, the unfair trade practice is fines and penalties, or prohibited trade practice fines and penalties is $5,000 per non-willful act. So even if you didn't know you were doing it, you can still get fined up to $5,000 per non-willful act. But if you did, well, not you guys, but the person in this scenario, it can be up to $10,000 per willful act. Okay. And these are unfair trade practices or prohibited practices violations. All right. So producer duties and reporting requirements. Producer equals agent. Producer equals you once you have your license, which you all will soon. Got some core responsibilities. Act in good faith and fair dealing with clients. Do what's in the customer's best interest. Provide accurate policy information. Disclose material facts, right? Because if we were breaking any of those, we could be violating some of those unfair trade practices that we talked about in part 1. Maintain fiduciary duty with premiums. Fiduciary duty is just your financial responsibility when handling money that's not yours. So the insured's and the insurer's money. When the customer hands you the premium and you need to get that to the company, or the insurance company issues a life insurance check, things like that, you need to get that to the customer. No commingling funds. Keep it in a separate trust account. You know all of this because we went over it in part 1. Obviously, keep client information confidential and report felony convictions within 30 days, but not just felony convictions. You must submit any of this information within 30 days. Address change, name change, felony convictions, and administrative actions all must be reported within 30 days. The exam frequently tests whether you know if it's 30 days for all producer reporting requirements. Do not confuse this with other timelines. Okay, so penalties for license violations. This gets a little confusing because, we have been focusing on the 5,000 for non-willful acts and 10,000 per willful. They vary a little bit, okay? When we're talking about agents and producers versus insurers, and there are some, minimum first violations, things like that we're going to go over. But the most tested, most common things the exam likes to ask is this, but you need to be careful on how the question is being asked. So there are different examples of insurance code violations, right? Failing to report your address change. You could get a minimum first fine of $1,000. Now, technically, you can get up to a $5,000 fine. And that's normally what they're going to ask you is the 5,000, 10,000, right? And if it was willful, you can get up to 10,000, right? If you're purposely hiding out, not telling them that. But it must have a minimum first violation penalty of $1,000. So even if you forgot to just change your address or change your name because you just got married, you could be fined, or you will be fined a minimum of $1,000 for that first violation. So that would really, really suck to have to pay $1,000 just because you forgot to change your address, right? But misrepresenting policy terms, failing to maintain requiring continuing education, not disclosing material facts, operating without a valid license. It's going to depend on the situation, the scenario. How many times have you done this? Is this the first time? Is this willful? Is this non-willful? What kind of records are you maintaining? Has there been multiple complaints? Things like that. So while the minimum first violation is $1,000, and you could see that question, so be careful for how it is worded. Second or subsequent violation or knowing violation, $5,000 to $50,000. This is just a range, okay? When we're talking about $50,000, this is when we're going to get into fraud. And it can be 10,000 for willful, things like that. So this is just giving you kind of the range that the commissioner can work within. You're generally going to see the $5,000, $10,000 questions, right? Non-willful and willful, then you know what they're asking for exactly. If they're asking about first violation, you need to then see, are they talking about the agent or the insurer? Because the first violation is a lot higher for the insurance company. So for an agent, the first one is a minimum of $1,000. So even though you could have been fined 5,000 or 10,000, but let's say the commissioner wants to go easy on you, it was something simpler like address change, right? They may only do the 1,000, right? But if an insurance company's first violation, their minimum is $10,000. And then frequent violations can go from $30,000 to $300,000. Now, again, that's just the range that the commissioner can go off of. We're going to get into, and for fraud, and you'll have to know the maximum numbers for fraud. But which violation are they talking about in the question? Is it the first one? Then we're going to be wanting to answer with the $1,000 or $10,000 answer, depending on who they're talking about, an agent or producer or the insurance company. Are they just asking what is the violation for a willful or non-willful act? The penalty, $5,000, $10,000. Okay, and then we'll get into fraud. So make sure that you are comfortable with the differences there and different ways it could be asked. So make sure that you're paying attention to any keywords in the exam question. So unfair trade practice penalties, as we were talking about, unwillful violation, up to $5,000 per act, up to $10,000 per act for willful. And additional consequences include license suspension, revocation, cease and desist orders, potential criminal charges for fraud. The commissioner has broad authority to protect consumers and impose multiple penalties simultaneously. So just make sure that you are comfortable with how they're asking that and what they're looking for. Okay, so California Life and Health Producer Licensing, some eligibility requirements, the application process, how you maintain your license. A lot of this is recap again from video 1, but a couple things to go over here. So in order to even sit for your exam, you must be 18 years old. You must also complete your pre-licensing education in the state of California. Not all states require this. California is one that does, and they actually track your time requirements. If you do not already have a certified pre-licensing course, you can grab one on our site. We have a partnership with WebCE where you can get 10% off. They already have the lowest priced courses across the board. And then you'll also get 20% off of a tutoring session with us. But there are pre-licensing requirements in the state of California. Now it says 52 hours total. And you're probably like, what? You said it was 20 hours in the last one. Okay. The way they're coming up for this, it is 20 hours per line of authority. So life equals 1 line of authority. So that is 20 hours. Health and disability, that is 1 line. So that is 20 hours. Okay, but that just equals 40. They are also adding in the 12 hours of ethics. So please pay attention to how the question is worded. Generally, they're going to say how many hours are required per line of authority. The answer would be 20. How many hours is pre-licensing education is required for life and health insurance license combined? 40 plus 12 hours of ethics. If they're asking how many hours plus ethics total, then it would be 52. They're generally going to ask the question of 20 hours per line of authority plus 12 hours of ethics. Okay. Pay attention to how it is worded so that you are answering it correctly. Understand where that 52 came from, but generally they're going to ask you the 20 plus 12. And you must pass your state exam score with a 60% or higher. That is awesome. Most states it is 70%. California just 60. All right, application process. Submit fingerprints for background check. Complete application through the CDI website and pay your required fees. And receive appointment from an insurer within 1 year of license issuance. So after you pass your exam, it's pass, then background check, and fees and application, and then appointment. You need to be appointed with the insurance company that you're working for, and you've got 1 year to do that. So maybe you go and pass the exam, but you're not, you want to go work, or maybe the place that you were lined up for didn't work out, you must be appointed to a company within 1 year. Your license may become inactive until you do. But if you did all of that and you are appointed, your license is good for 2 years, as long as you complete your 24 hours of CE, which includes required courses, and it's not required that you get an errors and emissions insurance in California, but it is recommended, and most companies will require you to carry it, but it's not actually required by the state. So 24 hours of CE every 2 years. So lots of different hours, lots of different numbers. Let's go and break this down a little bit and write it in a little bit more organized way. Hello and welcome to FastPass University, the only place where you can learn all your insurance exam content free, state by state. No paywalls, no giant courses you're forced to buy. All right. Let's jump back actually really quick and do a couple notes on the penalties and violations, because I know we added in some new numbers and I want to make that clear. So penalties and fines for an agent. First violation equals $1,000 minimum. For an insurer, first violation equals $10,000 minimum. All right, so agent versus insurer. Now, non-willful acts can be up to $5,000 per act, and willful violations up to $10,000 per act. And we did see the range, right? So range for second violations or fraud, which we're going to get into, is $5,000 to $50,000. You're not generally going to be asked this range question. It'll be specific when we get into the fraud, but just so you understand why that was on that slide, why we went over it. Okay. Now, the insurer, their range was $30,000 to $300,000. And they don't really get this unwillful or willful kind of break that agents get. They're getting fined $10,000 minimum for their first violation. For frequent violations or more serious violations, it's going to fall within this range. Again, we will get into the numbers that you need to know for fraud, but I wouldn't worry too much about the ranges. I would pay attention to this first violation minimum, and then the non-willful or willful violation, and the first violation for an insurer. And don't even worry about that other stuff until we get into fraud, okay? Now, let's go on to the pre-licensing requirements, okay? That we were just discussing. Okay, PLE, pre-licensing education requirements, okay? 20 hours per line of authority. So if you are taking the life only exam, 20 hours. If you're taking health only, 20 hours. If you're taking property, etc., right? And if you're taking them combined, then it is 40 hours plus 12 hours in ethics. So that's how they're getting the number 52. You're normally going to see the question looking for this answer, 20 hours per line of authority plus 12 hours in ethics. Okay, but pay attention to how the question is worded because they could be looking for 52. And if you were just taking life only, you would have to do 20 hours plus the 12 hours in ethics, health only, etc. So pay attention to how the question is worded. 90% of the time, the answer they're looking for is that one, 20 hours per LOA, line of authority, plus 12 hours in ethics. Write that down, make a flashcard, be comfortable with that. Now, that is pre-licensing education, not to be confused with continuing education. So this is pre-licensing, before license, before you are licensed. After licensed, after you are licensed, you never have to sit down for this exam again as long as you keep up with your renewals. Okay, so these would have continuing education requirements, right? So you're continuing to learn. You're keeping up with the changes in laws and regulations. That's why they require it. Because if somebody took the exam 40 years ago and just paid the renewal fees, I mean, things have changed, right? When Uber and Lyft became a thing, there were so many changes that happened. The insurance companies had to make things up and kind of just jump in with different things. And then those policies have evolved. And now it's a lot easier because Uber and Lyft have been around forever. Those are some of the things that maybe would have been taught in the continuing education, things that are now in the exams that weren't in them before. Regardless, you need to do continuing education. Your license is good for 2 years. And within that time frame, within that 2 years, you must complete 24 hours of CE. You'll need to go in and get a certified CE course. Sometimes the company that you're working for will have one that they recommend. We also have those available through our partnership with WebCE. You must complete 24 hours of continuing education every 2 years. And 3 of those hours must be in ethics. So it's not 27, it's that 23 of the 24 hours must be in ethics. So before you are licensed, that's called your pre-licensing education, right? You need 20 hours per line of authority plus 12 hours in ethics. If you happen to be taking the life and health exam, it's going to work out to 40 hours plus 12, totaling 52. But generally, the test question is going to be looking for the 20 hours per line of authority plus 12 hours in ethics. After you are licensed, the licensing period is 2 years. The renewal period is 2 years. How long is a license good for? 2 years. They could ask it any of those ways. Or what must an agent do to renew their insurance license after the 2-year period or within that 2-year period? Not after, within. You must have completed 24 hours of continuing education. 3 of those must be in ethics. And you must pay renewal fees. And you do that all online. Okay, so that's just a recap on some of the hours and numbers and timelines that we have gone over so far. Okay, so those are the most testable points regarding continuing education and pre-licensing, but they couldn't keep it that simple, could they? There are a couple other ones that you need to know. One, for what you need to do in order to have the correct licenses that you want, but two, to answer test questions. So we already know that it is 24 hours every 2 years. And within that 24 hours is a 3 hours ethics course that must be included, or 3 hours of ethics courses that must be included. One of those will be an anti-fraud training. Generally, they're just going to ask 3 hours in ethics, but it could include that in the question, so just be comfortable with that. To be able to sell long-term care policies, it is 8 hours initially before selling. So after you get your license and you want to sell long-term care products, you're going to have to go through an 8 hours long-term care class. A lot of times, the company that you're going to be appointed with is going to set you up with these additional ones that we're talking about, okay? They're going to put you in a long-term care class and an annuity training class. They're going to have this set up. When I got licensed in California, I worked for Allstate, and I had reciprocity, and I was able to just transfer my licenses from Arizona at that time. However, we didn't have these additional requirements in the state of Arizona. So when I got my licenses switched over to California, I had to sit through an 8-hour long-term care class, an annuity training class, and a variable life insurance class. I was in classes for 2.5 days, but Allstate set it up for me. It was just, they helped me with it. So it's going to depend on where you go. And then non-term life insurance, one-time 4-hour course for agents. This came into effect on January 1st, 2025. So I didn't have to do this because I moved out of California in 2018. However, just kind of giving you that to get your license and you pass these additional things. Now you can go out on your own and get these. There's going to be packages you can get. You can go online, go to the Department of Insurance and find them. But generally, you're going to get these through with the company that you're working for because they want you to sell these policies. They'll help set you up in these, but you need to know the numbers and know what they are for. And also, you need to know them for if you want to sell these products, right? So, um, long-term care and annuities is 8 hours. Variable life is 2 hours, and non-term life is 4 hours. Now you can see there are some different ones for annually, etc. Not generally going to go those deep into the details. I would focus on what those initial numbers are. Not as often tested, but it could be. So we like to go over it. Plus, you need to know it for selling these products in the state of California. So make some flashcards, be comfortable with these numbers. But the biggest one is going to be this 24 hours every 2 years with 3 hours of ethics. They could possibly throw in that 1 hour of anti-fraud training into the question, but that falls within ethics. All right. Exam trap. Product specific training, LTC, annuities, etc., is required before selling those products, not just for renewal time. So excess hours up to 24 can carry over to the next renewal period, but ethics, long-term care, and annuity carry over as general credits. That's more just kind of things you need to know for when you are licensed as well. Okay, replacement training requirement. All new life producers must complete a 4-hour replacement training course before selling life insurance or annuities in California. This is a one-time requirement. Who needs it? Any producer who will be involved in life insurance or annuity transactions where existing coverage may be replaced, including term to permanent conversions. basically anywhere that you're going to work, this could happen, right? Unless you're working somewhere that only writes life insurance policies for people that have never had a policy, you're going to be in the business of replacing coverage, right? So chances are you're going to need it. So replacement training is also a 4-hour requirement. And it's going to go over replacement regulations, disclosure requirements, comparison forms, suitability standards, all of those things. Again, a lot of times the company that you're working for is going to help lock these in for you, set these up for you. If not, again, you can find all of this on the Department of Insurance website. Test scenario. A newly licensed producer wants to sell life insurance. They must complete a 4-hour replacement training before their first life insurance sale, even if they completed all other pre-licensing requirements. Okay. Anti-fraud training. As we said, you're going to have that 1 hour of anti-fraud training. It's going to fall within those ethics courses, and it helps you recognize fraudulent activities, or teaches you how to report suspicious claims. It tells you your producer legal obligations. It's going to just be a part of that ethics training. Just letting you know what it'll go over. And then you must be appointed. Producers must be appointed by an insurer to sell their products. Appointments must occur within 1 year of license issuance. We talked about that a couple slides ago. And insurers, so the company you work for, must notify the CDI of appointments within 15 days. Producers cannot receive commissions without a valid appointment. 1 year to get appointed, 15 days for the insurance company to report it. They're going to have systems in place to do so. You can also check online if it's been done, talk to the company that you work for. But they want you selling products. You want your commission. They're going to handle this. Okay. All right, so life and health policy replacement rules. One of the most tested topics on California exams in regards to the regulation section, okay? Replacement occurs when a new life insurance or annuity policy is purchased and an existing policy is lapsed, forfeited, surrendered, or otherwise terminated. California has strict rules to protect consumers, because that's the main purpose of the Department of Insurance and the commissioner, from unsuitable replacements. Okay, so you are going to be replacing policies. It happens, right? People have policies. You're trying to sell them. Insurance companies are trying to gain new customers everywhere. But there are strict guidelines and rules in place to protect the consumers, protect the public anytime we're replacing policies. And they do not take these lightly, right? We cannot be putting people in a worse situation without clearly explaining the benefits. I did say in video 1 that there are situations where people may switch to you even if the policy is more expensive, or maybe if they are losing some type of benefit they had, as long as you are honest with them and clear and follow the replacement rules. We had situations that I've had that happen in real life, where we sat down, went over a policy with somebody, explained it to them, and they were like, you know what, I understand that this is a bit more, but I'd be more comfortable having my policy here with you. Or they signed their home and auto, and then they want to come in and they want to talk about, are they in the best spot with their policy, etc. But in order to do so, you have to submit a replacement notice, provide comparison forms, and document suitability. We're going to go over those in a little bit more detail on the next slide. You must verify comparisons, notify the existing insurer, and maintain records for 5 years. So if you do any type of policy replacement, whether their policy is lapsing, forfeited, surrendered, or terminated in any way, shape, or form, and they're getting a new policy with you, it's considered replacement. You must notify the existing insurer, submit that replacement notice, keep your records on file for at least 5 years, because the insurance commissioner can come in at any time and investigate those. You need to have those on hand. And the consumer rights And the consumers have the right to receive all disclosures. They get a free look period and right to compare policies. Right? They have the right to look at what's going on. You need to give them all their disclosures, and they have a free look period, a time frame in which they can change their mind and get their money back. So those replacement notices we were just talking about and those requirements. Producer must provide a notice to the applicant, a form explaining replacement at the time of application. Okay, when they are applying for this policy, you must give them a notice that explains the policy replacement. So notice to applicant at time of application. They must also get a comparison statement, a side-by-side comparison of the existing policy and the proposed policy. You also must get an applicant signature. Applicant acknowledges replacement if they acknowledge that the replacement is incurring. You need a signed statement that they understand what is going on. Sometimes they'll give you a scenario question where you get back to your office and realize that the applicant didn't sign it. Can you sign it for them? Can you submit it without them signing? Things like that. No, you must get a signed statement from the customer. Now, generally, a lot of things happen online, electronically these days. Life insurance, though, is one of those businesses where people still really like that face-to-face, old school kind of transaction. So there are still a lot of life insurance agents that sit down in customers' living rooms and go over policies with them, where they come into the office, etc. And the exam is always going to be worded, well, at least for now, it is still very much worded as if we are hand delivering policies and getting wet signatures in person. So whether it's a wet signature or an electronic signature, the customer must sign it, and it is them signing that they acknowledge that this replacement is occurring. And you must list all existing policies being replaced. So they could say, what must an agent provide at the time of application for a replacement policy? And it is the notice of application, explaining the replacement, a comparison statement, and a list of all policies being replaced. And they must receive a signed statement, a signed signature from the customer acknowledging that this is happening. And the producer must submit all forms to replacing insurer within 5 business days of the application. So send notice to existing insurer within 5 business days of receiving replacement notice and maintain records for 5 years. Verify policy comparison, accuracy, and ensure producer completed the replacement training. So the insurance company must make sure that you are even able to write this. You must have taken your replacement training course, right? It's 5 business days for both producer and insurer notifications, not calendar days. So 5 business days and 5 years for hanging on to policy records. All right, moving on. Replacement scenario, what is required? So here is an example of how they may word a question on the exam about replacement policies. Maria, age 45, meets with producer John about purchasing a new whole life policy with $250,000 coverage. During the discussion, Maria mentions she currently has a $100,000 term policy from another company that she's considering dropping because the premium just increased. So, what must the agent do? They must recognize that this is a replacement. This is a replacement transaction because Maria is talking about terminating her existing coverage, terminating her existing term policy in connection with purchasing the new whole life policy. So, a little trigger, red light, flag, something needs to go off that says this is a replacement. Okay. So then you know what actions and steps you must take. So John must provide the replacement notice. When must he provide that? At the time of application. He must compare the policy side by side and present that. So present a comparison statement showing both policies side by side. And if Maria's like, yep, I want to do that, I understand, he must obtain Maria's signed acknowledgement, all at the time of application. Okay, can't submit the application and then show her the side by side or get that signed acknowledgement. All of this needs to be done at the application before submitting it. Then you submit the documents within 5 business days. John submits all replacement forms of the replacing insurer, who then notifies Maria's existing insurer within 5 business days. Common test question: what if Maria doesn't mention the existing policy? Producer must still ask about existing coverage and treat it as a replacement if applicable. Okay, so now we're going to talk about annuity transactions. I'm not going to go into detail about what annuities are. You will find those in our other training videos or in the main content of your course. We are focusing mostly on what the laws and regulations section are compared to these policies, what you need to know when it comes to this part of the test. So California has comprehensive suitability requirements for annuity sales to ensure that products match consumers' needs and financial situations. These rules apply to all annuity transactions, whether they are replacements, exchanges, or new policies. Okay? You need to make sure that the product you are selling is suitable for the customer, right? This is so that you are, not just trying to get a commission, not just putting them in some policy to make money. This needs to make sense for the customer. And how do you do that? One, by information gathering. Producer must collect detailed information about the financial status, tax status, investment objectives, and other relevant data to determine suitability before recommending an annuity. Generally, the company that you work for is going to have some kind of software, some things like that, that's going to help you answer some questions with the customer and come up with some suitability recommendations, policies that make the most sense for what they're looking for. But it could still be a pen and paper analysis. This needs to be done. You must have it on file. And you must have reasonable grounds to believe that the annuity is suitable based on the collected information. Okay. You need to be able, at any point, if somebody said, why did you recommend this policy? Be able to explain why you did, right? And that's going to come from that information that you gathered and putting them in the best policy. If a customer says, we want to put this money in an annuity, but our son goes to college in 2 years and we're going to need it then, and the policy you want to put him in has a very high early penalty withdrawal for the first 7 years, that's not going to make sense for them to be putting them in that policy. If somebody's very, very conservative, they don't want a lot of risk, you're not going to put them something that's maybe variable or higher risk. It has to be reasonable for what is suitable for them. And you must keep all of that recommendations and documentations in writing and maintained for at least 5 years. You can be held liable for producer violations. You can't just say, I talked to them and this is what they said they wanted. All suitability determinations must be documented in writing and maintained for 5 years. So you must gather the information and do a suitability analysis and then make your recommendations off of that suitability findings, right? And everything must be in writing and you got to keep it on hand for 5 years. Annuity training and supervision requirements. As we talked back a couple slides ago, you must do at least 8 hours for your initial training. It is required before your first annuity sale for new producers. There are also 4 hours of continuing education for annuities. Oops, I was trying to circle that. Every 2 years, right? So your licensing period is good for 2 years. You do have your 24 hours of regular continuing education Within that, 3 of those are ethics. And if you are selling annuities, you also need 4 hours of annuity continuing education. So we're now at 28 hours, right? And insurers must review annuity transactions within 30 days. So your insurer must review any annuity policies that you write within 30 days. They're generally going to be doing it much sooner, right? Especially if there was a replacement involved, right? Because how many days does the insurance company have to notify the company? 5 days. So it's usually going to be much sooner than that, but you need to know those numbers. Another important number, since we're looking at numbers of annuity, is the 5 years for records. What must be documented when you are doing annuity transactions and recommendations? Their financial information, their tax status and investment objectives, reasons for recommendation. Why are you recommending this product? And customers' understanding of the product. How is that documented? With the signed acknowledgement. You must also document surrender periods and charges, right? So if there are certain time frames where you would have charges or fees for surrendering, sometimes you'll see annuities with, a 7-year, a 9-year, 5-year surrender penalty time frame. Liquidity needs analysis. Liquidity is just kind of cash, right? So in that scenario I used where they're going to need that money within 2 years to send their son to college, that needs to be liquid. If it is tied up with a bunch of surrender charges and things like that, it wouldn't work for them. If there were any alternative products considered, that needs to be documented, and you must have that signed customer acknowledgement. If a consumer refuses to provide financial information, the producer cannot make a suitability determination and should not proceed with the sale. Even if I'm not sharing that with you, just tell me about your products. While you generally can tell them about the products, you cannot proceed with the sale. Do not submit the application if you have not received their financial information and you were not able to do that suitability analysis. Okay. Now moving on to the health portion. Okay. So if you are also sitting for the health exam or taking life and health together, these are some required health coverages and mandates when we're talking about laws and regulations for the California Life and Health Insurance exam. These are required health coverages, required health mandates. California imposes specific coverage requirements on health insurance policies beyond the federal minimums. Okay, so these are required provisions, required coverages, things that must be included in all health insurance policies. Okay, they must have a mental health parity, preventative services, and maternity coverage. The question could be as simple as California required health mandates or coverage for health policies must include, and it could list these 3 and then something else, which would be the incorrect answer. So know those, but you may need to know them more in depth. Okay. So we're going to dive in a little bit deeper. Mental health and substance abuse disorders must be provided in the same terms as medical surgical benefits. They must be the same as the other coverages that they provide in your policy for going to the doctor or going to the hospital or things like that. Same co-pays, same deductibles, and annual lifetime limits, and no discrimination in coverage. Okay. So mental health and substance abuse need to be treated the same as everything else medically, surgically in their policy. Same copays, same deductibles, and annual lifetime limits, and no discrimination on coverage. Preventative services must be covered at 100% with no cost sharing. It must be free to the insured, including annual exams, immunizations, cancer screenings, and well child visits per ACA requirements. So these are going to follow along with the Affordable Care Act. All of these are also covered in the Affordable Care Act, but they're just backing it up and saying it is required by California too. So even if maybe something were to happen or change, because it could be kind of like, why did they have to say this? The ACA already covers these things. If that changed federally, it would still exist at a state level. Okay, so preventative care is your immunizations, your mammograms, pap smears, cancer screenings, well child visits, your annual checkups, things like that. Because if you are doing those things, those are considered preventative care. You are trying to catch things early on, staying up to date on your health. Obviously, if they were to find something right away, if you're going in every year and getting your cancer screenings or whatever the recommendations is for mammograms or getting your immunizations, it's going to cost them a lot less to cover those things than it will when you're coming in with something stage 4 cancer that hasn't been caught until now. Maternity coverage. Pregnancy is covered as any other medical condition. Minimum 48-hour hospital stay must be covered for normal delivery, vaginal delivery, 96 hours for C-section. They love this question. They love this question. They love this question. Know this. Boom, there's an easy exam answer right there. Okay? So how long must there be coverage for minimally when a woman has a baby, right? 48 hours for normal delivery, vaginal, and 96 hours for C-section. They have to cover at minimum that long. Some people could say, oh, after my C-section, I was there for 6 days or whatever. They have to, at minimum, cover 96 hours for C-section, 48 hours for normal. And newborn coverage is automatic for 31 days. They love that question too. So obviously, you just delivered a baby or just had a C-section and you are holding your brand newborn baby in your arms. Are you going to go online or call your insurance company and let them know right away that the baby's covered? Or what if there's complications, in the delivery right away? It's impossible, right? So they allow that the newborn baby is covered as a person on your policy immediately at time of birth for 31 days. You've got 31 days to then add them to the policy. Okay? They love, love, love both of those questions. So make sure you are comfortable with that. All right, moving on to disability and coverage timelines and CalCobra. Not going to go over disability policies too much. You're going to want to go over that in some of our other video lessons or within your course to go over how disability policy works. But make sure that you do understand, the elimination period, which is the waiting period, versus the benefit period, as well as reoccurrent disability. So if the same disability returns within 6 months, there's typically no new elimination period. These are going to kind of be policy specific. So again, go over those in the disability section. But we are going to talk a little bit about California SDI. So the benefits did change in 2025. So the benefit is 70 to 90% of average weekly wages from the highest earning quarter, minimum $50, with a maximum of $1,681 a week. This covers non-work related illnesses, injury, pregnancy, childbirth, and surgery. So it's not covering work-related injuries, because where would that fall under? That would be workers' comp or workman's comp. But it does cover pregnancy, childbirth, and surgery. This is unique to California. There's a lot of states that do not consider pregnancy a disability. I actually was pregnant with my daughter while I was in California, and I did have a couple complications and received disability for a little while, and it was extremely helpful to get through that period with that. Moved to Illinois, they do not have those same options or benefits. So this is unique to California, and it's pretty amazing. So just wanted to go over that. The numbers are 70 to 90%. It is going to kind of depend on what your position was, what the disability is. That's up to them. Maximum benefit 1681, and it covers illness, injury, pregnancy, childbirth, and surgery. And there is a 7-day waiting period before the benefits begin. Now, this is California state disability, so the state SDI. And CalCOBRA. COBRA is the Consolidated Omnibus Budget Reconciliation Act, right? This is your right to continue your coverage once you are terminated or no longer with the company. It allows employees and dependents to continue group health coverage after a qualifying event causes loss of coverage. You're going to pay the full premium plus 2% administration fee. They could ask that question. So under CalCOBRA, how much will the insured pay to continue their coverage? Full premium plus 2% administration fee. Employees losing coverage can continue for 36 months for termination, reduced hours, divorce, legal separation, dependent child losing eligibility, or employee becomes Medicare eligible. But the answer is that employees losing coverage can continue for 36 months. California mirrors federal COBRA, but may extend to smaller employer groups. So 20 plus employees for federal, but it is 20 to 19 employees for CalCOBRA. They can step in and offer this CalCOBRA continuation. All right, for up to 36 months for termination, reduced hours, divorce, legal separation, dependent child losing eligibility, or if you become eligible for Medicare, then you would no longer qualify for this coverage. All right, and it is the full premium plus 2%, 36 months, and it offers it for 2 to 19 employees when we are talking about CalCOBRA. All right, so health coverage scenario question. Jennifer is covered under her employer's group plan. She gives birth via C-section. When you're seeing that, automatically some numbers should be popping in your head. On Monday morning, what is the minimum hospital stay the insurer must cover without requiring prior authorization? So what would the answer be? 96 hours, right? Because she had a C-section. California law requires a minimum maternity stay of 48 hours for normal vaginal delivery and 96 hours for C-section. So again, that correct answer was 96 hours. The insurer must cover Jennifer's hospital stay through Thursday evening at minimum. Doesn't necessarily mean that they're kicking her out or stop covering. It's saying that they have to at least cover during that time. She's protected in her policy to be covered for at least that amount of time. It could be more. Don't confuse the 48-hour normal delivery with the 96-hour for C-section. Also remember, the newborn is automatically covered for the first 31 days. No separate enrollment needed during that time. After those 31 days, they need to be added to the policy officially. Coordination of benefit rules for the state of California. These are different for each state. Of course, it would be easy if every state just picked the same thing, but they don't. So, what is coordination of benefits? It is when a person has coverage under multiple health plans. The coordination of benefit rules determine how benefits are paid, right? You cannot profit from insurance. You cannot get paid out from a policy, from two different policies for the same one thing, right? You can't have a car insurance policy and total your car and have Allstate and State Farm sending you a full check for your vehicle. That's not how it works with property and casualty. It's not how it works with life and health. So there are instances where maybe a married couple have each other on each other's policies, or they have children, they're on both policies. There has to be a coordination of benefit rule in place to prevent duplication of benefits, to prevent duplication of coverage. Also, who wants to pay for a bunch of different policies and things like that? So they'll usually kind of coordinate with each other, and that is called the coordination of benefits. So there can be no duplication of benefits. Total benefits paid by all plans cannot exceed 100% of allowable expenses, right? You cannot get paid for more than what the loss was. COB provisions must be consistent with California state regulations, and they cannot be used to delay necessary healthcare services, right? So that's why these are in place. So that while you are needing coverage, two insurance companies and the hospital aren't arguing over who's going to pay and what, right? So there's things in place so that these coverages can be covered right away and everybody knows who's covering what. The primary plan is always going to pay first according to its terms without considering other coverage. The secondary plan pays after the primary, reducing payments so combined total doesn't exceed the allowable expense. So, how do we figure out whose policy is primary? So, the named person. So, if we're talking about a married couple, the named person, their own work, their own policy, there is primary. So, if they are also listed on their spouse's policy, that one would become secondary. Now, what about the children, right? So let's say the kids are listed on both policies. How do they know whose policy is first? And California follows the birthday rule. So when children are covered, or when a child is covered by both parents' plan, the parents whose birthday falls earlier in the calendar year has the primary plan. Not who is older, not who is younger. Whose policy falls earlier in the calendar year has the primary plan. So I'll give you this example. My birthday is August 6th. My husband's birthday is August 3rd. Let's say, and that's true. And we also have a son whose birthday is August 1st. But we each have our own policies, right? Me, husband. If something were to happen to me, my policy is going to pay first, right? Something happens to my husband, his policy is going to pay first. Now let's pretend our 4 kids are listed on both of our policies. I don't know why somebody would have all these policies. Generally, one should be fine, but anyway, need to know how it works. So no matter what, my children were covered under both of our plans. Because my husband's birthday is 3 days before me, he follows on the birthday rule, the one that falls first in the year. So his policy will always be the primary for our dependents, for our children. Individual versus group plans. Fully insured group plans follow state COB laws. Self-funded ERISA plans may have different ones, but for the testing purposes, you're going to be asked this question, so you must know the birthday rule and the scenario. Generally, they're going to give you something further apart than August 3rd and August 6th. Then our son's birthday is August 1st. It makes for a very crazy first week of August. Special Medi-Cal as payer of last resort. Medi-Cal is California's Medicaid, right? And Medicaid is a place for those that are of financial need. If for some reason you had these policies plus Medicaid, which generally you're not going to qualify for Medicaid if you have these other policies, you work somewhere that you still fall below the income limits, but your work provides the policy, etc., whatever, Medi-Cal is always last, right? Because this is funded on state policies. If you have commercial insurance, Medicare, etc., those must be billed first. The birthday rule is commonly tested concept for determining primary care coverage for children. Make sure that you understand it. All right, long-term care specific requirements that are specific to California. California has extensive regulations for long-term care insurance sales to protect seniors from unsuitable coverage and ensure proper consumer education. So there's an 8-hour training required if you're going to be selling long-term care policies. So in addition to any annuity trainings or anything like that, long-term care, you must also have 8-hour specific training before selling any policy. So once you're first licensed, you need to do this. Then you must also do this every 2 years as part of your CE requirement. So it must be repeated every 2 years. A shopper's guide must be delivered at the time of solicitation or application. So before, or before application. It cannot be given to them after you submit the policy. So they must be given a shopper's guide, right? And that's kind of just going over the policy that you are soliciting or trying to sell to the customer, right? This guide helps consumers compare policies and understand long-term care insurance. And then the outline of coverage would be after that. The detailed summary of the policy benefits, limitations, and exclusions must be delivered before or at application time. So both of them are at or before application. So this one's kind of like a brochure. This one is more detailed. So shopper's guide and outline of coverage both must be provided at or before application. And while most places and most policies have a 10-day free look period, long-term care policies must have a 30-day free look period. Okay, generally when we're talking with anybody in the senior population, they're going to have a 30-day free look period, a little bit longer. And just for recap, free look period is how long you have to return the policy and get a full refund for any reason. Okay, it's how long you have to change your mind. So 8 hours of training before you sell, and every 2 years. You must complete an 8-hour training. What must be given to the customers at or before application? The shopper's guide and the outline of coverage. And how long is the free look period for long-term care policies in California? It is 30 days. When in doubt, 30 days. There's also going to be long-term care replacement and suitability rules, and they're going to look very, very similar to the replacement and suitability rules for all the other policies that we've talked about. So you must give them a notice of replacement. You must do, these are required disclosures, things that you must give to the customer. Comparison of benefits, notice of replacement, comparison of costs, reason for replacement, consequences of the replacement, any losses of benefits or new waiting periods, premium changes. Okay. Producer must help complete a worksheet documenting income, assets, and insurance to verify affordability. You must make sure that this is suitable for your customers, and you must keep these records on hand, right, for at least 5 years. Anytime we're replacing any policy across, whether it's life, annuity, long-term care, we need to be following those same steps. Suitability standards, producers must determine that the long-term care policy is suitable based on their ability to afford it, their ability to pay premiums without financial hardship, making sure that they can understand the policy terms and benefits, their long-term care needs and preferences, and other available resources for long-term care costs. Exam alert. If applicant's income consists only of Social Security or SSI, supplemental security income, long-term care insurance is presumed not suitable unless adequate with other assets. Okay, so if they ask you, Barbara only has Social Security income, would it be benefit to be putting her in a long-term care policy or having her purchase a long-term care policy? Without them giving you any other information, the answer is generally going to be no. All right, a long-term care sample question. Producer Sarah is meeting with Robert, age 68, who wants to purchase a long-term care policy. Robert's only income is his $1,800 monthly Social Security benefit. We just talked about this. But he has $85,000 in savings. Sarah completes the long-term care training requirement last year. What must Sarah do before selling a long-term care policy? Now, they did provide us some other information here, okay? You must, one, verify her trading currency. I mean, they gave us to that in the policy, but just trying to make sure these are your thoughts. So she completed that last year. That's good for 2 years, so she's good to go here. She's able to sell it. Your next thought process. Since Robert's income is solely Social Security, long-term care insurance is presumed not suitable. However, they gave you additional information in this question, right? He has $85,000 in savings, and that may justify the sale if premiums don't cause hardship. So while yes, he does only get $1,800 a month Social Security benefit, if the question had stopped there, the question would be not suitable. We can't really say whether or not this is suitable, but just for you to know the process and understanding, right? And if the question was, what must Sarah do before selling? Complete required documents. She must provide the shopper's guide, the outline of coverage, the personal worksheet of suitability, okay? Making sure that this makes sense for Robert. So key point, Sarah must document extra justification of suitability because of the Social Security only income, right? So this question wasn't, can she sell this to him? We're not sure. We don't know. We are not sitting down and actually filling out this personal worksheet with Robert. But what must she do? Assess the suitability carefully and complete the required documents. All right, moving on to claims and payment requirements for California. 15 days, 40 days, 30 days, this should say. So, California has strict timeframes for claim processing to protect consumers and ensure timely benefit payments. Okay, so 15 calendar days to acknowledge receipt. Insurers must acknowledge claim receipt within 15 calendar days and provide necessary claim forms or instructions. Failure to acknowledge can result in penalties. Then they have 40 calendar days to accept or deny. After receiving the claim documentation, insurers have 40 calendar days to accept or deny a claim. If accepted, payment must be made immediately. And 30 days for denial. If a claim is denied, the insurer must provide written explanation within 30 days, citing specific policy provisions and reasons for denial with right to appeal. So, and let's say an insured has a claim on October 1st, and whether they submit it on the app or call it in or however they do it, on October 1st, they let the insurance company know, hey, I have a claim. The insurance company then has 15 days to acknowledge. 15 days to say, hey, we got your claim. All right. Then they must send out forms for the customer to submit, right? To fill out, things like that. A lot of this is done electronically, but you need to know the time frame. So then once they receive those forms, they could ask you, an insured filed the claim on October 1st, and the insurance company must, respond by when? October 16th, right? Or the insurance company didn't respond to the customer until October 20th. Did they do that within the acknowledgement of claims requirement? No, they failed to do so, okay? Once we receive those forms, once the insurance company receives the forms, they have 40 days. I know we're going on to the next slide, but 40 days to decide, right? Accept or deny. So they can deny the claim and they can tell them that over the phone or in person or however they decide to. But After that 40 days, they have 30 days to send in writing. So be careful how they're asking the question. Sometimes they'll say all of the following are prohibited claims practices except, or, and it'll just say, denying claims. No, they can deny claims. Claims get denied, but it has to be within reason. There has to be specific policy provisions or reasons stated. And even if they let them know within this 40-day window, they have 30 days to actually send out the written reason behind it. All right. So make sure that you are comfortable with the 15, 40, 30 days and how they play out in the scenarios that are regarding claims. All right, moving on to penalties, prohibited acts, and fraud. We are not going to jump too much into the prohibited practices. Those are gone over in a lot more detail in part 1. Again, if you have not watched that already, the link is in the description. You're going to want to watch part 1, most likely before this video, or go back to it again after this video, etc. So we cannot be doing misrepresentation, right? False statements about the policy terms, or twisting, misrepresenting, trying to get them to twist their arm, come over to our policy, or rebating, right? That's bribing. We can't do churning, excessive replacements for commission, just trying to rewrite policies within the same book of business to make more commission. We cannot commingle funds, right? That's part of our fiduciary duty, which commingling is using client premiums for personal use. All right, so unfair trade practices, as we know very well, unwillful acts can still be $5,000 per violation. And if we did know what we were doing, it is $10,000 per act. But when it comes to fraud, the penalties can be much higher. That's where we were seeing those larger ranges, some of those first slides we went over, right? And now you can get fined kind of both, right? So you could be getting in trouble for rebating and fraud, or twisting and fraud. And so that's where those ranges come into place. What you need to know when it's to fraud is the maximum number, really, right? Because we already know that it's $5,000 violations, and it can go up to $50,000 when fraud is involved for agents and producers. When we're talking about the insurance company, it's much higher, $30,000 to $300,000 per violation for fraud. They take them very seriously. Now, while the commissioner cannot actually put you in jail, they can submit all of this to get criminal penalties for insurance fraud. The attorney can pick those up. And so felony penalties that you need to comes with fraud is up to 5 years in a state prison and fines up to $50,000, or double the amount of the fraud, whichever is greater. So it could actually be higher than $50,000. Also, restitution, payment to the victims, and permanent license revocation. You're not going to be able to get licensed again, at least in the state of California. And if it was up to 6 months in a county jail, and fines up to $1,000 may be granted in lieu of or addition to other penalties, right? So fraud can be with or in addition to them. All right, moving on to some federal in relation to life and health. I'm not going to go over these in too much detail because you will learn about these in sections, but what we will talk about is where California plays its role in regards to these and how these may show up in the regulations portion of your exam. So HIPAA equals privacy, right? Privacy protects patient health information. It is the Health Insurance Portability and Accountability Act. Usually what you're going to be asked about HIPAA is what is it there for, and it's to protect patient health information. And as a producer, you must maintain confidentiality, obtain authorization for disclosures, and standard procedures so that you are doing your best to protect clients and customers' private information. Affordable Care Act is something that's gone over in detail in the health portions, but it does require those 10 essential benefits, right? Some of those, like pre-existing conditions, cannot be a cause to not write a policy. Allows dependent coverage up to age 26, eliminates lifetime and annual limits, mandates preventative care, things like that. And we talked earlier that while this is at a federal level, California has its own. They kind of, just backed it all at a state level. So that if anything were to happen federally, it is still in place to protect consumers to keep these rights. Medicare Supplement, or Medigap. Test question can be as simple as asking, what is Medicare Supplement previously known as, or what is another term for Medigap? And just know that those terms go interchangeably. Now, in California, it does standardize plans A through N. You may have heard if you're watching just a general video, that it is mandated, A through L or things like that. In California, it is A through N. The plans A through N must be standardized to supplement original Medicare. The 6-month open enrollment period is at age 65. So from the day the person turns 65, they have a 6-month open enrollment window with guaranteed issue rights and strict marketing rules. Does require separate licensing and training. Whenever we're dealing with the senior public, they always get extra rights, extra requirements, usually some extra training required as well. So in relation to the Affordable Care Act and Covered California, these are some of the scenarios where they may show up. So Medi-Cal, right? Medi-Cal eligibility. Medi-Cal, MAGI, has the modified adjusted gross income thresholds, MAGI. And this is for adults age 19 to 64. They qualify with a household income up to 138% of the federal poverty level. This number may change as of January 1st. And if it does, we will make sure to update our videos as well. Children under the age of 19 qualify if the household income is up to 266% of the federal poverty level. Cost sharing reductions, CSR. Consumers qualify for varying cost sharing reductions between 138% and 250% the federal poverty level. And it reduces out-of-pocket costs like deductible and co-payments. So this is kind of limits where they can offer credits, right, to lower the cost of insurance through the affordable marketplace if you don't qualify completely for Medi-Cal, which is, the Medicaid for California. The advanced premium tax credits. So these are where they are going to, those credits that can come into place and lower your premium, and sometimes it's quite substantial. So it is available to households with income not more than 400% federal poverty level. You're generally not going to be asked on the percentage of poverty levels. I would still write them down when you're taking your notes. You will more want to understand what these all are for, right? This is calculated by Covered California and paid directly to insurers. You must be purchasing through Covered California to receive credits. So let's say somebody is looking up a policy and it is $1,000 a month, but they may, once they type income requirements, and they make too much to qualify for. They don't make enough to afford this $1,000 a month. They type it all in, and depending where they've not more federal poverty level, let's say they $600 credit. That goes to your policy premium, and then you would pay the remaining, okay? Covered California requirements. California Health Benefits Exchange. It's an individual exchange for consumers. Covered California for small businesses, CCSB, serves businesses up to 50 employees. Must purchase qualified health plan through Covered California to obtain premium tax credits. So small businesses can also receive credits health coverage. All right, agent requirements. Agents must complete all Covered California agent agreements and certification requirements before writing QHP applications. So there are some additional trainings. If you are selling these policies, Generally, wherever you're going to work will help you with all of the things that you need to obtain so that you can rightfully be writing the policies that you are meant to. And dependent coverage, children may remain on parents' individual or group policy through their 26th birthday. Disabled dependents may continue beyond age 26, and a child who ages out has COBRA rights. Right? Not every state offers that, but California is one of them that does. Now it is telling you to memorize the income thresholds. However, that is rarely tested. I'm not going to say that it's not going to be on your exam, so don't come for me when they do ask you levels. And again, they may be 2026. We will update the videos if they most 1 or 2 questions you're going to get on this. So if this part's stressing you out, don't stress on it. It has rarely been seen that these questions come up, but I'll never say never, right? All right, so ACA key definitions and enrollment periods. So qualified health plans, health insurance plans certified by Covered California are on the Covered California website. They must meet the ACA requirements for essential benefits, and they are available in bronze, silver, gold, and platinum tiers. They are guaranteed issue. All new group and individual health policies must be guaranteed issue, right? There's no pre-existing condition limitations anymore, so everyone needs to be guaranteed issue. Cannot deny coverage based on pre-existing conditions, cannot charge higher premiums based on health status. Again, not going to jump too hard into this because you should know this from your health sections, but the 10 essential health benefits that you must know, again, gone over in your health videos or content or text, but we'll go over these real quick. Ambulatory patient services, emergency services, hospitalization, maternity and newborn care, mental health and substance use disorders, prescription drugs, rehab services, laboratory services, preventative and wellness services, and those must be covered at 100%, and pediatric services, including dental and vision. So those need to be available to children through the policies. The open enrollment period is when anybody can enroll in or change health coverage, and that is typically November 1st through January 31st for coverage starting January 1st. Outside of open enrollment period, there are ways that you can qualify to enroll outside of that time period, but they have to be for qualifying events, marriage, birth of child, loss of healthcare coverage, things like that, and those would be called special enrollment periods. So know this, November 1st through January 31st is the open enrollment period, and to apply and qualify and get approved outside of that, you would have to have a qualifying event, and it would be called the special enrollment period. So the special enrollment period allows outside OEP due to qualifying life events, loss of health coverage, marriage, divorce, or legal separation, birth or adoption of a child, change in residence, change in income affecting subsidy eligibility. Typically 60 days from qualifying event to enroll. The health plan tiers, the number on the left, the number of the percentage they're saying, is how much the plan pays. So bronze is 60, silver is 70, gold is 80, platinum is 90. Obviously, the more that the company covers, the more that the policy covers, the more expensive the policy is going to be. And the number on the right is how much the customer pays. So company and insured. So if it was bronze, 60-40. Silver, 70-30. Gold, 80-20. Platinum, 90-10. They can ask you the questions on the tiers and how much is covered under those, so be comfortable with those numbers. And of course, they have to have those minimum essential coverages that we discussed. Know the difference between OEP, anyone can enroll, that's open enrollment, and SEP, special enrollment period. And also memorize the metal tier percentages. Okay, moving on to HICAP, HICAP, Health Insurance Counseling and Advocacy Program. Free Medicare assistance for California beneficiaries. Okay. What is HICAP? It is a federally mandated program, state and federally funded, provides free assistance to Medicare beneficiaries and their families. It is administered by the California Department of Aging, and it is operated locally by area agencies on aging. Topics covered. HICAP provides assistance with Medicare Parts A, B, C, and D, Medicare Advantage plans, Medicare Supplement Insurance, also known as Medigap, prescription drug plans, Medi-Cal, long-term care insurance. What does this agency do? They help with educational services. They help explain Medicare coverage options and compare plans and costs. They help consumers know their rights and protections and help them navigate enrollment periods. Medicare is confusing. It is complicated. I teach it left and right. I have taken exams on it. I have sold it. It is confusing. So for somebody that does not work in it all the time, or people in, the elderly community may need a little bit more help going over these things. I think most people need help going over these things. It's very confusing, right? You just hear about it all the time, oh, Medicare, Medicare, Medicare on commercials and this and that. But it's confusing, right? So what's really nice is that the HICAP offers help and educational services so that consumers can talk about these things without, just somebody trying to sell them a policy. So they are consumer advocates, consumer advocacy. They assist with claim denials. They help resolve billing disputes. They address coverage issues. They can help them file complaints. Some HICAP offices provide legal help. They can represent them in appeals, help them with their rights, and there's multiple ways to access them. So just remember what it's for. Remember that it is free. It is federally mandated and covers Medicare, Medigap, and LTC insurance, and know that it is run by the Department of Aging through local area agencies on aging. All right, so we have made it through the most important, most loved by the exam material for the California Life and Health Insurance Exam Laws and Regulations section. Now, it seems like a lot, but you've got this, and really it's just a whole lot of timelines and a couple terms and concepts. So just get comfortable with those numbers, do your flashcards. We're going to do a practice quiz here to wrap this up. So I will read through the questions and then we will go through the answer key at the end. Number 1, a producer must notify the California Department of Insurance of change of address within how many days? 10 days, 15 days, 30 days, or 60 days? Number 2, when must a replacing insurer notify the existing insurer about a policy replacement? Within 3 business days, 5 business days, 10 business days, or 15 business days? Number 3, how many hours of initial training must a producer complete before selling annuities in California? 4, 8, 12, or 16? Number 4, under the ACA birthday rule for dependent coverage or dependent children covered by both parents, which parent's plan is primary? The parent with higher income, the parent whose birthday falls earlier in the calendar year, the father's plan is always primary, or the parent who enrolled the child first? Notice there, the answer is in the question. Take those easy wins and move on. Number 5, what is the penalty for a willful unfair trade practice violation by a producer? $5,000 per act, $10,000 per act, $25,000 per act, or $50,000 per act? Number 6, what is the free look period for long-term care insurance policies in California? 10, 20, 30, or 60 days? Number 7, within how many days must an insurer acknowledge receipt of claim in California? 10, 15, 30, or 40 days? What is the actuarial value of silver tier health plan under the ACA? 60%, 70%, 80%, or 90%? Number 9, what is the minimum hospital stay that must be covered for a cesarean section delivery in California? 48 hours, 72 hours, 96 hours, or 120 hours? And number 10, HICAP, HICAP, Health Insurance Counseling and Advocacy Program, is administered by which California agency? California Department of Insurance, California Department of Aging, California Department of Healthcare Services, or Employment Development Department? All right, let's see how we did. Question number 1, the correct answer was 30 days. You need to report changes of address or name or criminal convictions within 30 days. Number 5, 5 business days of receiving replacement notices. Remember, 5 and 5 for replacement. 5 business days of notifying the insurance company, and you must keep records on file for 5 years. Number 3, 8 hours. Producers must complete 8 hours of initial annuity training before their first annuity sale, then 4 hours every 2 years after, and these are CE hours. Number 4, the parent whose birthday falls earlier in the calendar year. The question said birthday rule, the answer had birthday in it. Move on, right? That was a nice, easy one for you. And some of the questions will be easy. Some are going to be very hard. If one of them just seems so easy, but you're like, yeah, that's got to be what it is. It probably is. Answer it and move on. Don't overthink it. Number 5, $10,000 per act. We should know this inside and out, right? Unwillful violations are $5,000 per act. Willful violations are $10,000 per act. Number C, 30 days. California long-term policies have a 30-day free look period, which is longer than most other insurance products. This allows consumers adequate time to review the policy and decide if it meets their needs. Number 7, 15 calendar days. Insurers must acknowledge receipt of a claim within 15 calendar days. After receiving complete documentation, they then have 40 days to accept or deny a claim, and then 30 days to denial in writing. But if they have accepted it, then they must pay immediately. Number 8 is 70, silver. I can't answer these off the top of my head. I've never been able to. I don't know why. It just doesn't stick. But what I do is I write them down. When you're taking the exam, you're going to have either scratch paper or you can write on the board. And so when the question comes up, I do know that it's bronze, silver, gold, and platinum. And I know that it starts at 60. So bronze is 60, and then I would know 70, 80, 90. And then I can answer the question. You can also write down things, right? As long as the timer has started and the test has began, write things down on paper the second the test begins so that later on you can just, glance real quick and find that answer. Number 9, 96 hours. 96 hours for C-section, 48 hours for normal vaginal delivery. And number 10, California Department of Aging is who helps administer the HICAP. So master the timelines, 30-30-30 rule. Almost all producer reporting is 30 days. 15-40-30 claim rule, 5 days replacement. Know your timelines, make your flashcards, write them down. Watch for test traps, calendar versus business days. When training is required before a first sale rather than continuing education. Make sure that you understand the difference between acknowledging claims and paying claims, and you will do just fine. Focus on California specific rules. If they made the rule, they're going to want to test you on it, right? So anything that has the name California in it, you may most likely see those ones on the exam. Read each question carefully. Look for keywords: must, required, minimum, maximum. Eliminate obviously wrong answers first. If you see numbers and answer choices, recall the specific California timeline or requirement. Don't overthink. Your first instinct is usually correct. I almost always say don't go back and change an answer unless you are 1000% certain, right? Manage your time. Don't spend too long on any single question. You know this, move on. And if you don't, one question's not going to make or break you. You've got this, and now you are in an excellent spot to pass the state law and regulations section of the California Life and Health Insurance exam. Please stay tuned. We will be dropping new videos each week on all of the states and then also all of the exam content in general. Please make sure to subscribe so you can get those notifications, and also helping get this channel before as many people as possible, because we are one of the only states giving you the state laws and regulations for free. So thank you for hanging out with us, and best of luck. You totally got this. See you soon. All right, moving on to some federal laws in relation to life and health. I'm not going to go over these in too much detail because you will learn about these in your health sections. But what we will talk about is where California plays its role in regards to these and